In the dynamic world of stock trading, investors have developed numerous strategies to capitalize on market movements. One such strategy is short selling, a practice that allows investors to profit from a decline in a stock's price. So how's it done? A short position is essentially a bet against a stock's performance. Unlike the conventional method of buying low and selling high, shorting involves selling high first and buying low later. In short selling, an investor borrows shares of a stock from a broker, sells them at the current market price, and aims to buy them back later at a lower price, thus pocketing the difference. To initiate a short position, an investor needs to have a margin account with a brokerage. This account allows investors to borrow stocks against some collateral, typically cash or other securities held in the account. Once the account is set up, the investor identifies the stock they want to short. The cornerstone of short selling is borrowing shares. Investors don't own the shares they plan to short. Instead, they borrow them from a brokerage. The brokerage, in turn, may borrow the shares from another client's account, or may have an arrangement with other institutions to borrow shares. Post-borrowing, the investor sells the borrowed shares in the open market at the current market price. This sale credits the investor's account with the proceeds from the sale. The final step comes when the investor buys back the same number of shares they initially sold, aiming to do this at a lower price than the selling price. This repurchase can happen anytime, depending on the market conditions and the investor's analysis. If the stock price has indeed fallen, the investor will buy back the shares at a lower price, return the borrowed shares to the brokerage, and pocket the difference as profit. The practice of short selling, though, can evoke mixed reactions within the financial community. On one hand, it's praised for aiding price discovery, drawing attention to overvalued stocks, and contributing to market efficiency. However, this strategy comes with its fair share of risks, as shown by the GameStop saga of January 2021. At the time, GameStop had become the most shorted stock in the US market, with over 138% of its float shares sold short. The catalyst? A collective of retail investors from the Reddit community Wall Street Bets triggered a buying spree, causing a sharp spike in GameStop's stock price. This surge forced short sellers to cover their positions by purchasing shares, further driving up the price in a self-reinforcing cycle known as a short squeeze. The stock price, initially below $20 USD, rocketed to an intraday high of $483 USD on January 28th. The aftermath saw significant financial fallout for certain hedge funds and massive losses for short sellers. The GameStop saga has become a modern-day emblem of market dynamics and the newfound power of retail investors in a digitized world. As you can see, short positions offer a mechanism to profit from declining stock prices, and while they come with high risks, they are an integral part of the market's ecosystem, contributing to price correction and liquidity. Whether an investor should engage in short selling largely depends on their risk tolerance and market outlook. Have you ever thought about shorting a stock, or have you done it already? Let us know in the comments below. Don't forget to hit that like and subscribe button so you're always in the know.